Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoteric Capital Markets. Today's topic is on valuation, right? This is the third in our three-part series. Here we're looking at the value of the stock market versus the value of the bond market. All right, so 2 weeks ago, when we started this series, we were looking at what's called the Buffett valuation ratio. The Buffett valuation. That's where you compare the value of the stock market to Wall Street. To Main Street. Right? So we're comparing Wall Street to Main Street. We're comparing the total market cap of the equity market to the total dollar value of GDP. Right? That's the calculation. Well, we saw on that metric that we were at all-time highs. Right? All-time highs. We were even more expensive than during the dot-com bubble. Right? It was just oh my God, ridiculous levels based on that metric. All right, so that was episode 1. And last week was episode 2. And there we compared PE ratios to their own history. All right, so we started with the stock market relative to Wall Street relative to Main Street. Now we're just going to look at Wall Street relative to Wall Street in the past. Okay? So we looked at trailing PE ratios, forward PE ratios, cyclically adjusted PE ratios, and the conclusion there was things are expensive. Right? They're not surpassing the dot-com era. Right? All right. So unlike week 1, week 2 said they were expensive, but we didn't get to the ridiculous level that we saw during the dot-com bubble. So we want to extend this today. The third piece is comparing the stock market to the bond market. All right? 3 different ways of looking at it. Now, the reason for that is some people suggest that you can argue that markets are not overvalued if you compare them to the bond market. All right? So we have our 2 primary markets, our stock market and our bond market. And the argument is that the bond market is even more ridiculously valued than the stock market. So don't worry about the fact that the stock market's overvalued. Okay. And the basis for this, right? The basis for this is that if you think think of the price of any stock or the index, right? The price of any asset for that matter, it's a discounted value of the future cash flows. So the argument goes, if you discount those cash flows at a negative interest rate, right, at a big enough negative interest rate, you can actually justify valuations today. All right, that's the argument. Okay. So again, that argument boils down to the basic point, the basic premise, that the bond market has to be even more overvalued than the equity market. Okay. Just so we're all clear on what the argument is and where we're going here. So let's get into the data, right? Let's see what the evidence says. So here we're going to start with the stock bond cross price, all right, or stock bond valuation ratio. This is the value of the S&P 500 relative to the value of the entire Treasury bond market. All right, this is an index of the entire Treasury bond market. So we're going to start back here in 1988, Jan 1 of 1988, and we're going to index this price to 1 and see how it evolves through time. So we can see going into the dot-com bubble, things got very expensive, right? Stocks got out of whack relative to bonds. Stocks became very expensive. And then they came crashing down, right, during the recession. And then, of course, we had to run up to the Great Recession. And things came crashing down. Now, where we're at today is the dotted black line, right? You'll remember that. I tend to use it in most all of my charts. All right, this is where we're at today. Right before the outbreak of the coronavirus, on February 18th, we actually hit an all-time high. So this is 2 days before the coronavirus really started to infect equity prices. we were at an all-time high. And look at that level compared to the dot-com bubble. This is like the Buffett valuation ratio here, right? Things were so ridiculously priced, we can't even compare them to the previous most ridiculously priced market. All right, so that's where we were, right, in February, into February. So where we're at today, things have corrected a little bit, right? Equity prices have come down a bit and bond prices have gone up with the fall in yield. So things have corrected a little bit, but again, look where we're at relative to history. There's nothing in this time zone here, people, right? There's nothing to compare it to. We are still well above .com valuation ratios. All right, so yes, it's less expensive than it once was. Is it cheap? Oh, hell no. Hell no. No, we're not even close. This is still just ridiculously expensive valuations. This is essentially the same result we got from week one, right? The Buffett valuation ratio. Things that just started to come off from their, oh my God, I can't believe it. Things are so expensive level. But does that make them cheap today? By no means. By no means. Okay, so on the first chart here, we're looking at, again, the stock market versus the total treasury bond market. The total bond market. What I'm going to do next is separate the bond market just into long bonds, right? Just into bonds greater than 10 years in maturity. Okay, so let's go back to the charts here. Again, this is the S&P, but now we're just looking at long bonds. And long bonds, based on this index, are defined as bonds that have at least 10 years remaining in their maturity. Okay? So where are we at today? Again, the dotted black line tells us where we're at today, and then we can use that to compare where we were previously. Okay? So we've come way off our highs. Way off our highs. Now notice, this time we didn't get as expensive as we did during the dot-com bubble. All right? Unlike our first chart, when we look at long bonds only, we'll see we didn't get anywhere close to where we were during the dot-com bubble. All right, but we're still expensive, right? We're still teetering around the second highest level that we've ever seen. So where are we at today? Well, where are we at today? We're very close to where we were going into the Great Recession. We're very close to where we were at the start of the Great Recession. All right. So things are a little cheaper, right? And again, I'm using some air quotes here. They're a little cheaper, right? Because the last 2 or 3 years, here, we are looking at just some ridiculous valuations, right? But things are a little cheaper. But it's still kind of sobering, isn't it? To conclude that things are cheaper, but we're still more expensive than we were going into the Great Recession of 2008. Okay. So again, stocks relative to the total bond market are still mind-boggling expensive. Stocks relative to only long treasury bonds, it's a more balanced case. It's a more neutral case, right? It's there's not overwhelming evidence that things are completely nuts, but it still doesn't give me much solace in the fact that we're currently at a higher valuation ratio than we were during the precipice of the Great Recession. Okay, let's go on. The third piece of information here. What we're going to look at this time is the S&P 500 earnings yield. Okay, so think of this as this is simply the PE ratio inverted. Right, it's a trailing PE ratio flipped over, inverted. Right, that metric is called the earnings yield, and that's going to be the blue line here on our chart. Okay, see how that's behaved throughout time here. This chart goes back to the 1970s. So the blue line is our S&P earnings yield, and we're going to compare that to 10-year Treasury rates, the 10-year yield. Okay, that's the, I don't know what we call this, a magenta colored line maybe? Let's call it the magenta colored line because I have no idea what color this actually is. Now, for each one of these, we have our dotted line. All right, so our dotted blue line tells us the most recent earnings yield, and we can compare that to history. You can see we're just shy of 5% now on an earnings yield basis. All right, and we can do the same thing with the 10-year yield. Right, these are just month-end values. So at month-end, we were at 64 basis points on the 10-year. And month-end being here April 30th. Okay. Now, what we're really looking at, right? The focus of this chart is the bars. It's the difference between our earnings yield and the 10-year yield. That is sometimes used as a valuation metric to tell, again, a relative valuation metric to tell us whether or not the stock market is rich or cheap relative to the bond market. So our dotted black line here, tells us the most recent gap, the difference, right? And we can see how that compares to history. Now, the way to read this is the higher these bars, the cheaper equities are relative to bonds. Okay? So you can see where we're at today. We had a few months. Remember, these are monthly sticks we're looking at here. We had a few months here where we were more expensive, but not often. Not often. So when we look at that chart, in general, equities look pretty cheap. All right. You might even say they look damn cheap. But remember, this is a trailing PE ratio that we invert. Right? So price today versus the trailing earnings for the last 12 months. Now, again, just invert that. When we look at that chart, that assumes that our trailing earnings are going to continue to be relevant going forward. And we know that's not the case. Right? We've got 2 consecutive quarters coming at us with negative GDP numbers. That is clearly the textbook definition or the loosely defined definition of a recession. And we know earnings are declining. So based on a trailing earnings yield basis, equities do look very, very cheap. But that's not a fair way of looking at it. Right? Because, again, forward earnings are going to be much less than that. But that is the strongest argument. That is the strongest argument for the equity bulls right now. We have to keep that in mind. That's the strongest one. So overall, our evidence today is mixed. It's mixed. It really depends on how you look at it. Are equities cheap? There's no evidence that really suggests they're cheap. Are they ridiculously expensive? Well, yeah, we saw one metric, right? The first one I showed you. Stocks versus the total treasury bond market. Stocks still look to be ridiculously expensive. Relative to long bonds, they're still more expensive than they were going into the going into the Great Recession, right? Stocks today were still more expensive than going into the Great Recession, but they're not ridiculously valued based on that metric. The third metric is the strongest argument. It's the strongest argument. So we are, we put everything together, right? The 3 weeks here that we've been doing this, the Buffett valuation ratio, the PE ratios, and the stock bond ratios that we looked at today. We put everything together here, and we are really, really having to stretch people to justify these valuations. There's just not a whole lot to hang your hat on, right? It's like probably 85-90% of the weight says we're either expensive or we're ridiculously expensive. And then the remaining 15% says, well, maybe we're not quite there yet. Is anything cheap? No. There's no evidence really to suggest that things are cheap. All right, so that's our message for today. I'm Don Rich. You just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep.